Breaking news out of the Fed and some fresh comments from New York Fed President John Williams. Steve Liesman has the details. Hi, Steve.
Hey, thanks very much. John Williams, one of the more important members of the Federal Market Committee. He's talking now in New York, says inflation is still too high, but he does see some progress, especially from the 9% where we were at. He says he's been somewhat surprised by the resilience of the housing market, that it has seemed to bottom. That was the one of the phrases used by some observations in the minutes I just released at 2 o'clock today. Williams goes on to say inflation expectations have been remarkably well anchored, so not that much concern on that score. And he supported the decision in the June meeting to pause, saying slowing the rate of rate increases makes sense to give time for, among other things, to figure out the lags from monetary policy. And he supports now a meeting-by-meeting decision on rates. However, he says the projections, in other words, the forecasts of the Fed show, quote, we don't think we're done yet. Morgan?
All right, Steve Liesman, thank you. Joining us now to talk more about the Fed and the rate picture is Jay Barry, co-head of U.S. rate strategy at JPMorgan. Jay, it's great to have you on. You're the rate guy. What you have to say, Wall Street pays attention to. So I do want to get your reaction to the minutes, which do seem to show maybe a little bit of a compromise in terms of that pause, but the fact that we are not done hiking rates. There was more for the hawks and the doves, and even just now, those comments from Williams, who's seen as more dovish, also signaling more hikes to come. Your thoughts?
Yeah, sure, Morgan, and thanks so much for having me this afternoon. I think our view is quite similar now, that the outcome of the Fed meeting was sort of eye-opening to us with how quickly and how much the dots shifted for this year and how many of the participants shifted towards 2 more hikes for this year. And it makes us think that the Fed is not done either. So prior to the meeting, we thought that the Fed would likely sort of be done by May, but now we've penciled in 1 more hike later this month. So we're slightly more dovish than the dots are, and mainly that's because we see a slower path for the economy than the Fed does. Though, to be fair, we don't see inflation moderating back to the Fed's target until sometime around this time next year. And that means that while Chair Powell certainly has control of the committee right now, and that's reflected in the desire to pause last month, we do think it's going to be harder to pause later this month, and that makes the case for another 25 basis point hike from there. And following that, I think it's going to be, as they said, going on a meeting-by-meeting basis and seeing how the data evolve. Because if the labor market remains as resilient as it has so far, it's going to be tough to make the case that the Fed should pause even once it gets past this July meeting.
What are your thoughts on the data so far? And I ask that because last week you ditched a bullish tactical view on treasuries. Why?
Yeah, I think there's been 3 reasons. First, again, we're sort of pushing out the timing for which we think that the Fed will be done raising rates. And that matters because typically it gets safer to own bonds when you're within 1 to 2 months of the final rate hike. And even though we think we're getting closer, the risk is obviously that the Fed would have to proceed past July. And it's the fact that you haven't seen the labor market really weaken substantially. Jobless claims certainly did rise back into the 260s, but then retraced lower. And the pace of payroll growth remains much stronger than we would have expected. As you and Steve were speaking about before, through the comments from President Williams, it seems like the housing market is holding in better than we would have expected as well. So I think that makes the case for being long duration here a bit more challenging. And further from that, I think there's a valuation and technical component as well. So looking at how the markets are pricing in the Fed, inflation, and in growth right now, it would actually make the case that 10-year yields should be sitting above 4%. So I think the valuation construct makes it a little bit difficult to be long right now unless you're sitting at higher yield levels than we are right now.
Gotcha. I want to get your thoughts on credit spreads, which, yes, maybe widened in recent weeks, but still, I would say, a bit subdued here. There's also a lot of talk about what's priced into the corporate debt market overall right now. Do you think the risks that are facing the market are fully realized?
So I'm just a humble rate strategist, and I don't want to get too far over my skis, but I know that our view on credit here at JPMorgan is that spreads are going to remain pretty range-bound for the balance of this year. That on one hand, the fact that the economy is slowing should be somewhat of a negative for credit spreads, but the fact that the supply dynamic is going to be a bit more benign and that we don't actually see a reason for the Fed to start easing until probably the second quarter of next year is sort of an offsetting factor in the other direction. So broadly speaking, we think that there's room for credit spreads to remain relatively range-bound around current levels through the end of this year in the high-grade space. In high yield, I think we're a little bit less sanguine because they've put in a very strong performance to start the year, so we expect a bit of a mean reversion there. So if anything, I think our credit team is expressing an up in quality bias between high grade and high yield for the balance of this year.